So, you check the ATR and see that it is $2.68. So, you set your stop loss at $2.68 below your entry. And you set your take profit point roughly $5 above your entry. And you have a proper trade with the risk-reward ratio of 2. In this example, we used 1 ATR as our stop loss and 2 ATR as our take profit targets. We made a 2% profit with this hypothetical trade. You can use 1 ATR as a stop loss, or 1.5 or even 2 ATRs, depending on your target, and how long you want to keep your trade open. For example, I use 1 or 2 ATRs as a stop while swing trading. And while intraday trading, I usually use 1 ATR for the stop loss. I just showed you a long position, and I want to show you a short position also. I am looking at the hourly Bitcoin chart now. Let's say that, hypothetically, your technical analysis says you should open a short position here, in the second red candle after the green ones in a row, and you decide to go short. Same way you did while opening a long position, you should check how much is the ATR. As you can see, the ATR is roughly $90. So, you should set your stop loss $90 higher than your entry point. As you can see, if you have put your stop loss tight, this candle could have touched it and closed your position. But it did not touch your stop loss and you have closed your trade with a profit. Unlike most of the indicators out there, the average true range is really easy to understand and really easy to execute. You can use the ATR on all time frames, and on any market including Forex, cryptocurrencies, and of course, the stock market. Please don't forget to hit the like button if you find this video helpful. And if you are interested in these kinds of trading videos, you may subscribe the channel. Thank you for watching.
Hello everyone, my name is Rainer and welcome to my video tutorial. In this video, I will explain to you how I actually use the ATR indicator to help me set my stop loss. So, the ATR indicator simply stands for Average True Range, which measures volatility. It measures volatility by calculating the average range over X number of periods using a mathematical formula which I wouldn't want to bore you guys with it. So for those of you who are interested in the mathematics behind it, you can actually Google it up and find out more. So the main purpose of this video is actually to show you how I use the ATR indicator in setting my stop loss. So looking at this chart, for example, say I got long at 117.25 over here, and right now I've already entered a trade and I'm looking to set my stop loss. So how would I go about setting my stop loss using the ATR? So the first thing I'll do is I go towards the MT4 indicator section and I'll click Average True Range. So that's the indicator we are using, and upon clicking it, I would actually select a 20 period and click OK. So what you see is actually now is lines that appear on your chart, which is actually the indicator, the ATR indicator values fluctuating over time. So at this particular point in time when I got long, right over here, the ATR is showing about 33, right? You can see on the right hand side the numbers which is moving on the right is 33 right now. So 1 ATR is 33 pips, and I typically use 2 ATR as my stop loss. So I'll take 33 multiplied by 2, which gives me 66 pips. So for this trade, my stop loss will be 66 pips, and what I'll do is I'll set my stop loss of 66 pips. So my entry is 117.25, and minus off 66 pips will give me 116.59. Okay, so I'll set it in red for easier illustration, and there you have it. You can now see that 117.25 is my entry and my stop loss will be in 116.59, and that's how I go about using ATR for this setup. So another particular setup I'd like to share with you guys is the chart of Palladium. So you can see that again, price is say for example it's in the range, and I'm looking to sell at resistance down here. So for example, I got short over here at say 810. Okay, so how am I going to place my stop loss down here? Again, I'll go towards the ATR indicator down here. I'll choose 20 period, and series of lines will come up which actually fluctuates according to the ATR over different periods. So looking at it, right, you can see that in this particular point of time, the ATR is doing about 15. So 2 ATR are multiplied by 2 and we get 30. So my stop loss will be 810 plus 30, which gives me 840. and again I'll highlight it in red. So green is where I enter and red would be my stop loss set according to the ATR. So if you would like to have me illustrate it better, here to here would be $30. Why is it $30? Because the ATR right here is about 15 and I multiply it by 2 because I use 2 ATR, which gives me $30, which is shown right here. So that's all I have for you guys on how I actually use the ATR in setting my stop loss. I hope you guys find it useful, and if you like it, please like this video, and if you really like it, feel free to share it as well. So thank you, and I'll talk to you soon.
Average true range, or the ATR, is a commonly used technical indicator, and it's primarily used as a measure of volatility in terms of pips or movements in price. Now the calculation is in fact quite simple. Firstly, let's define range. Now the range is the difference between the lowest traded price from the highest traded price in any given time period, and is measured in pips. Now the ATR averages out these ranges over a preset number of preceding time periods. The typical setting is a 14-period look back. Now the ATR is displayed as a line graph, with the line oscillating up and down as the value of the ATR increases and decreases. A rising ATR means the volatility is increasing, whilst a falling ATR indicates a fall in volatility. Now, a market that's consolidating is likely to have a falling or low ATR. A market that's breaking out or in a strong momentum move will likely to have a rising ATR. Now, the average true range can also be used when deciding where to exit your trades. Typically, a trader can use a multiple of the ATR as the preferred place to exit a profitable or losing trade. So, for example, if you enter a long buy order at a price of 1 spot 2535 and the current ATR for that particular time period was 10, then you could place your take profit target at, say, 3 times the ATR value. So that would be a 30 pip take profit target. So 1.2535 would take a profit target of 1 spot 2565. Conversely, you may place a stop at, say, 1.5 times the ATR. So that would be a 15 pip stop loss. That would take you out at 1 spot 2520. Now the ATR is available for most broker platforms, so it's well worthwhile checking it out.
Hey everybody, Bill Paulus here from Profits Run, and I want to show you how to use the average true range. It's a very popular technical indicator. I have that plotted here for a 14-day period. Well, let's talk about the definition of an average true range. Here I'm looking at a stock symbol F, Ford Motor Company, compliments of freestockcharts.com. And let's look at this price point right here and our average true range plot, which is around 30 cents. The range of a daily bar is simply the high versus the low. That's the range of the day. In this case, if you look at the legend over here, you can see this is about 50 cents. The true range, though, is from this previous day's low if it's higher than the high compared with the low of the day. So if there's a gap in price, the true range takes that into account. So the true range for this day right here is more than 50 cents. It's more like 70 cents. And so what the average true range indicator does is it goes back 14 days, adds up all of the true ranges for the past 14 days, and divides by 14. That's it. Now, how can you use the average true range? Well, in numerous ways, but some of the more popular ways is if you enter the market to go long, let's say right in here, you could place a stop one average true range away from your entry point, which would be somewhere around here. Or you could place the stop 2 average true ranges away. Or whatever your method would indicate is the best multiple of the average true range. Now also you can use it for taking profits. Let's say you enter here and your method calls for taking profits at 2 times the average true range. That would get you out right here. So those are just a couple of ways you can incorporate this terrific indicator into your trading discipline. Thanks for watching this video, and I hope you enjoyed it. For more free training, go ahead and subscribe to our YouTube channel, like us on Facebook, and visit ProfitsRun.com. This is Bill Polis wishing you good trading. Everybody, Bill Polis from Profits Run. I want to talk to you about stochastics, which is a commonly used technical analysis indicator to help identify so-called overbought and oversold points in the market. And here we have a setting of 8, 3% P, setting of 5. Now, without going into the formula, which is fairly technical, all you really need to know is how to use this indicator. What you do is in a downtrending market here, we're looking at a chart of Capital AHL.com. It's in a downtrend, and what you would be doing is looking for a point in the market where it's overbought. Stochastics help you do that. Here the stochastic is moving up to a maximum of 100, having come from a minimum of 0. So this oscillates from 0 to 100. Seldom will it hit 0, seldom will it hit 100. But when it's up in the range, up above 80, that tells you this market's getting to be overbought. Now, that only has relevance in a downtrending market. You can see if you look up here, that would have been an excellent place to go short. Because when a market is overbought, it's suggesting that there are no more buyers and that the sellers will now take control of the market, which is exactly what happened here as the market dropped. Again, the stochastics move back up above 80, suggesting this downtrending market was once again overbought, and you can see that's exactly the case. So the stochastics can be a very good timing indicator. Now in an uptrending market, we have here, you look at the stochastics which fall below 20 to help identify oversold points in the market, which would be here and here. But there's a problem, right? It did not fall below 20. Stochastic did drop, but not that much. So if you were following the rule of only buying an uptrending market with stochastic sell below 20, you would have missed this opportunity and again this opportunity. So no technical indicator works all the time. And you shouldn't worry about that because we're just looking at one stock here. During the same period, there were countless other stocks that were in an uptrend where the stochastics did fall below, giving you a chance to buy those stocks at the time. You always have to make sure that you identify the trend. For example, here's an uptrend, and here's the stochastics above 80. Identifying an overbought situation. But you would not act upon that because we're in an uptrend. Had you sold the market here or sold short, you'd have been disappointed as the market went on to make new highs. So you don't want to trade against the trend, only with the trend. So bottom line, in an uptrend, you're only looking for the stochastics to trade below 20. In a downtrend, you're only looking for the stochastics to trade above 80. Thanks for watching this video, and I hope you enjoyed it. For more free training, go ahead and subscribe to our YouTube channel, like us on Facebook, and visit ProfitsRun.com. This is Bill Pullis wishing you good trading.
Increasing the sensitivity of the regular relative strength index, or RSI indicator. Both of these indicators are oscillators used to identify overbought and oversold positions by measuring changes in the price of an asset over a given time period. But how does it work? As the name suggests, the stochastic RSI is generated from the ordinary RSI indicator by applying the simple stochastic oscillator formula. The result is a numerical value that goes from 0 to 1 and moves above and below the center line of 0.1. There are some versions of the stochastic RSI which multiply the results by 100, so the values range between 0 and 100 instead of 0 and 1. On these charts, the center lines are 50 and 0.5. Meaning that the overbought signal that usually occurs at 0.8 would be at 80, and the oversold signal at 20 rather than 0.2. Charts with a 0 to 100 setting may look slightly different, but both variants are interpreted in essentially the same way. The most common time setting for stochastic RSI charts is a 14 period. This means that if you apply the stochastic RSI indicator to a daily chart, the calculation will generate new data based on the past 14 days. When applied to an hourly chart instead, it'll only consider the past 14 hours. Just like most other indicators, traders can adjust the stochastic RSI settings to suit their own profile and strategy. The stochastic RSI indicator is often used to identify potential entry and exit points, as well as price reversals. A reading of 0.2 or below indicates that an asset might be oversold due to a strong downward momentum. On the other hand, a reading of 0.8 or above suggests an overbought condition as a result of a strong upward momentum over the predefined period. Other than that, readings for the closest to the center line, 0.5, can also provide insights about market trends. For instance, when the center line acts as a support and the stochastic RSI line moves steadily above the 0.5 line, it may suggest a continuation of an upward trend, especially if the line starts to move towards the 0.8 line. Likewise, readings consistently below 0.5 and trending towards 0.2 may indicate a downward market trend. Although the RSI and the stochastic RSI have a lot in common, the standard RSI moves relatively slower, producing a smaller number of trading signals. This means that the stochastic RSI is a faster and more sensitive version of the RSI. While this gives traders more opportunities to identify potential reversals in the market, it's also riskier because it produces more trades than missing signals. Due to its increased speed and sensitivity, some charts include a 3-day simple moving average along with the stochastic RSI line. The SMA acts as a signal line and is meant to reduce the risks of trading on false signals. As such, the stochastic RSI should be used along with other tools to help confirm the signals it creates, especially in volatile markets. To learn more about technical analysis indicators, don't forget to watch our other videos at Finance Academy.
A moving average is a widely used indicator in technical analysis and day trading. Moving averages help to smooth the price condition chart and can be used to help identify price trends or identify potential support and resistance levels while trading. There are two main types of moving averages: simple moving averages and exponential moving averages, SMA and EMA for short. Simple moving averages are also referred to as arithmetic moving averages. To calculate an SMA, you take the sum of the closing prices over a given period of days, then divide it by the number of days in that period. For example, for a 5-day SMA, just take the sum of the closing price data over the last 5 days, then divide it by 5. And since it's a moving average, it's constantly updated. old data is removed when new data becomes available. If your SMA is based on a short time frame, it'll be more volatile, but will closely follow the source data. And if you base your SMA on a long time frame, it displays a smooth and moving average. Exponential moving averages, also called exponentially weighted moving averages, work a little differently from simple moving averages. EMAs place greater weight on the most recent data points than SMAs, which means they react more significantly to recent price movements. Both kinds of moving averages are calculated using data from previous days, making them lagging indicators. In other words, they can only display changes that have already occurred. Because of that, traders and analysts commonly use moving averages alongside other kinds of indicators to get the best understanding of market trends. Stay tuned to Binance Academy for more about different kinds of indicators.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first, and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available. In this way, ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods. 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objectives. Use exponential moving averages for shorter time frames, or if you're analyzing fast-moving markets, as we have provide more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages. Our next video will focus on how to trade using moving averages. Don't forget to subscribe to our YouTube channel and visit our blog for additional information. If you have any questions, please let us know in the comments section and we will get back to you. We wish you successful trading with Trading 212. We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the three types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video where we showed you the most commonly used time periods when analysing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages. Don't forget to subscribe to our YouTube channel and visit our blog for additional information. If you have any questions about the strategy, please let us know in the comments section and we will get back to you. We wish you successful trading with Trading 212.
In this video we're going to take a look at the RSI, the relative strength.
Order filled. Order filled.
hanging by a thread, hung upon all the words you said, breaking free from this conformity that you force on me. Everything I do is one big show. It's about damn time that I take control. Put me under a microscope and watch me take.
This. I didn't realize I even had YouTube music pulled up. There it goes. Should be better. Still a little low. Doing a little better now. I had to take a little break. I was not doing good earlier. I was getting clapped earlier, but I just walk away for a little bit. Everything's just kind of choppy today. Up and down, no direction. No news or anything today, no economic data, so everything's just kind of in this little range here. Been in a 60-point range pretty much all day. 60 to 80-point range. This is like how the market usually moves. This. And then today, we've only moved like from this little, where this little box is up, like this little bit. Very choppy. A little hard to trade. I think I gotta go make me some W right quick. I'll be right back. Eat it. Right. Man, this market's choppy. Ain't much going on. You working hard today, Christopher? So hard. So Monday, you don't have like a lot of work to do on Mondays when you go in? Must be nice, work an hour. Be done, huh? Jeez. Jesus. Should get a little breakout above this. Looking for this 15-minute candle to break above. Get a little continuation here. A little whippy though. Looks like we're gonna get in.
Stop filled.
Immediately rejected down though. Let's get a little breakout here. One taps, two taps, three taps, four taps. Need a little flush through. I don't like that we're not breaking above here though. Like to see some strength going through this 15 here. There we go. That's what we wanted. That's what we wanted. A little push up here. If we can get up, I'm gonna take 2 contracts off at 5. Try and leave 1 runner. A little bit of trouble breaking above here. This closes green. I might add into this. Such a slow grind. Everything's a fight today to get any. They're defending this 16 to 17 area hard. Just can't get enough buyers to step in to break us above here. God. I'm off tomorrow. Softball game again tonight. I probably won't be on tonight either, just because I've been gone. Katrina will be home. Probably just spend time with her. Come on, what are we doing? I think it wants to break out. We just can't quite get enough buyers to push us up. Getting a little whippy now, though. I'm a little worried, to be honest. Like these big wicks at the bottom. Topping wicks are getting smaller and smaller. That's what we were looking for. Tell you what. Should have took that off right there. Come on, give me that 18. So I can get a little bit taken off here. A little push up. Come on. Come on. Let's get a feel. Come on. Come on. want to take some off here. Come on, don't do that to me. Push up. Big push up here. Our quarter off here, we're 50 cents off here from getting my fill.
Order
There
filled.
we go, we got that fill. I'm gonna change my contract, and I'm gonna add my stop here. I'm gonna go ahead and run that stop up to here so we can keep our profits. And push on up some more. I think we probably just take that off there.
Stop filled.
Alright, we're all out there. We'll take that. We'll take that. That's my trailing drawdown 53. I'm 570 up. That makes no sense. We shall take that. A little 500 point. I'm off tomorrow. I'm off tomorrow. I'd try to switch over to my 150 accounts. See if we can do anything with those. Now we push in a new high a day. If only we could have kept it, right? If only we would have held it. Can't be mad though. We are 575 up on that account today. And then on this account, we are 575 up. Lost a little bit on my funded accounts earlier today. Be careful with these. for a little pullback here.
Stop filled.
Pocket some profits here.
Stop filled.
And we're out. So let this one just run a little bit, honestly. Oh me. Oh, a boring day. You bored, Chris? Just leave. You know, your salary anyways. It's 2 o'clock. About your leave time anyways. I'm bored too. Did you see that TikTok Brandon just sent? That's hilarious. That shit is hilarious. Bruh, I'm gonna send you this Instagram. You gotta watch this shit. Is Nikki Glazier's or part of her roast for Tom Brady for Tom Brady's roast. It's hilarious. It's fucking hilarious. That shit's so funny. Yeah. Got a big push up here. Remember when we bought right here? How many way up here now? I actually think we're about to get a pullback here.
Order filled.
Should have took that off on the push up there. Yeah, that shit was hilarious, wasn't it? We get stopped out here now.
Stop filled.
And then we push back up. Oh. Oh, I don't think I'm gonna be able to come home when Nate's home. When Nate comes, just ain't no way. I work Friday. I'm off Saturday, Sunday, but I work Monday, Tuesday, Wednesday. Just ain't no way. This weekend? No, I said the weekend Nate comes. I'm not gonna be able to get that weekend. I'm not gonna be able to come, like, make that travel. No way. I'm off Saturday. I work Sunday this weekend. My schedule the rest of this month kind of sucks. Yeah, it's September that he's coming. Just ain't no way I'm gonna be able to get it off work, I don't think. I've already got 5 weeks off this year. 3 weeks for military. I took over 2 weeks for vacation. So I don't think I'm able to take any more time. like it wants to die here. Whoa.
Order filled. Order filled.
They really just buy that right back up like that? Jesus. No way. Liquidity sweep maybe under this. No way. Wowzers. And a hell of a liquidity sweep.
Order filled.
Oh no, I mean.
Order filled.
So adamant to short this market, and we have these short-term traders that are taking the market short on any kind of pullback here, and we're just seeing that manipulation right back up to the top side, and those early shorts are jumping right back out. They're getting stopped out, and they're just letting it run. So it's exactly what we just saw happen in the market was exactly what we saw John talking about here as it was happening. Mm-hmm. Yeah, this is one of those tapes where if you're looking at the way that the price action is functioning right now, it's doing exactly what John said, which is kind of rinsing out these shorts and squeezing them and adding them to a maximum pain until they're capitulating, and we're seeing all of these longs coming in supporting that move. And the smart money is kind of seeing that happen, where they can see that on any pullback, that's an opportunity to either add to a long position or open up a long position like we just did here on our Top Step X account. Yeah, we're doing that 50 clear out right now, and we're seeing a lot of bid to cover. We're seeing a lot of panic at the bids go right now, where we're seeing a lot of these prices just jumping right on up. Absolutely. What's going on over there, Chuckles? I hear you laughing over there. I believe so. What do you feel about that, Hogue?
Oh man, a boring day.
Yeah, and as long as we find bids on these pullbacks, as long as we find bids, that gets shorts very nervous. And there's definitely shorts right now that are continuing to take heat in this. And there gets to be a point where there's a breaking point. Everybody has a breaking point, and some desks have a certain marching order where they have to say, all right, we're willing to take this much heat, and above this level, we can't take any more heat. We're going to look to reshort this maybe in Globex, or maybe wait until later in the week. But they have their certain marching orders, and if we get to those levels, we're going to see exactly what we just saw right there, which was an explosion of contracts in that move right there. We're talking about, I mean, that volume right there was 5,200 contracts, I believe, on that blowout top there that just happened right there. So 5,200 contracts is, I mean, that's a lot of orders that are hitting the market right there. So There's obviously counterparties to each trade. There's people who are taking that short there, or there's people who are just getting out of their longs and just, saying, hey, that's good enough for me. But the more that we pull back, the more that we bid this up, the stronger that the market becomes, and the more difficult it becomes for shorts to hold this move. Wow.
Well, Chris, about time to leave work, ain't it? You got what, 15 more minutes, 30 more minutes?
Oh, we did. We just got stopped out on that pullback. We just basically puked from 50s down to 35s there. So I took out a couple bucks worth of profits there. I was trying to hold up the bid, but unfortunately in combines, you don't actually support the bid with any orders in the market. So wasn't able to hold it up with my with my sim orders here. Yeah, exactly right. Yeah, I'm getting back in this thing here myself.
Stop field.
Get a little push up here. push down, Jesus.
It's been going well. Just been trying to, eye some better trades, some better setups. Last couple of weeks, I had some decent trades, some decent strings of trades. But unfortunately, I don't think that I connected as well as I would have wanted to. Last couple of weeks gave us a tremendous amount of opportunities. And I think that, if you were really dialed in and in the pocket on a lot of these certain situations, I mean, we had that big roll-off in the news that printed about, the conflict in the Middle East. We had CPI, we had FOMC. There's a lot of different opportunities in the market, and they were difficult trading opportunities, but they were opportunities nonetheless. I'm always very hard on myself, and I always wish I would have performed better. And I think that unless I'm putting up, 6 figures in a day, I'm always going to be upset with myself unless I'm hitting that.
Order filled.
So obviously, I wish I would have performed better, but overall, it's been a pretty good, decent set of trading weeks in the last 2 or 3 weeks. I'm still in that ever-going quest to join Dakota on the top 5 of that leaderboard, and it's been a rocky road to get there, but I'm still having confidence in my abilities to get there over the next, hopefully in the next few months or so.
I don't like that big wick down there. It's not bode well for our longs.
Well, you know, I believe they have some websites for that that'll help you out with that. But in any case, you know, you definitely want to be not so hard on yourself, and you probably want to be journaling as much as you possibly can. And you know, it's one of those things where if you are always hard on yourself, you're never going to find joy in life. And you know, you really have to find the balance between being too hard on yourself and being accepting of your own faults and working on fixing them. If you're never working on fixing your own faults, then you're gonna stay in that cycle of, I guess, you know, self-loathing, so to speak, and not find any way of getting the light at the end of that tunnel. So you really just want to